one of the questions that I get asked all the time is about a Bitcoin mortgage. Hey, I have a very large portion of my net worth invested into these assets, but if I want to go get a mortgage, they won't actually allow me to get the mortgage because they don't underwrite these assets, which is a huge problem. So I'm very excited about this. Joseph, how are you?
Excellent. Good to be here.
I'm very excited about this. Let's start maybe first with, how does a bank underwrite a mortgage? Like if somebody goes to apply for a mortgage, what assets do they determine I can underwrite with? And then why do they not include some other assets?
A lot of it is really driven where mortgages actually end up going. So mortgages end up going mostly to Fannie and Freddie, right? Government. So they have a process to really look at a person's ability to pay. They'll look at what their income is. They'll look at what their assets are. They'll look at how much that person can put down in an overall transaction. And what's happened is that over the last sort of 60, 70 years of originating mortgages, they've learned a lot of things. And they've learned that it's really important for people to have the ability to pay. And over the course of on the back of really sort of 2008, the government decided that they're going to basically come up with these ratios on income. And they're going to want to be able to prove it, and they're going to want to make sure that that income is continuous into the future. So assets like Bitcoin and crypto is really hard for them to actually consider today, but they're really looking at all kinds of just other assets that are mainly liquid that they're really comfortable with.
Got it. And so when you think about this, Bitcoin and cryptocurrencies has obviously become an asset that wasn't here in 2008 and now is very, very popular. Is it just that they haven't gotten comfortable yet? Or is it something where they've identified specific reasons why they don't want to include it? Like, hey, we've done the work, but we don't want to include it.
Yeah. I mean, I think that they know that crypto's here, right? And it's here to stay. Mm-hmm. So I think that it's very, very clear that that's going to be the case. I mean, statistically, last year, 1 out of every 8 first-time homebuyers in this country sold some crypto for their real estate transactions. So I think it's undeniable that people have crypto and it should be considered. I think it's a matter of time. I think that it's probably going to take companies like ours and probably others as well to show them that this is a much bigger piece of individuals' wealth and that they're going to have to start to think about it.
So it really is just you need the upstarts to kind of push innovation, and then eventually they realize, hey, these people are making too much money. We got to get into that market, right? And they try to come compete.
Yeah, and then the reality is that this is wealth, right? I mean, I think that was sort of like phase one, right? Is this going to be around? Yes, it's going to be around. Now, does this make a borrower make their profile stronger, right? If they have the ability to liquidate some crypto to make mortgage payments, then that should be a consideration. And today it's not. And I think that's one of the reasons why we created our product, is because we saw that gap.
When you think about the product that you have, is it you just underwrite Bitcoin or cryptocurrencies, or you use it and holistically look at crypto plus whatever other assets they have?
Yeah, we have to look at the whole borrower, right? I mean, I think that's the element that a lot of people assume. Well, if I have Bitcoin, then a lender should be comfortable with me just having that. And the reality is, when you lend money to someone for 30 years, right, you've got to really feel good about that person. You got to feel good that they have the ability to pay. You've got to really look at all these other elements. And if you really just sort of think about what is 30 years? 30 years, you go back to early 90s, right? You had inflation, you had a savings and loans crisis, right? You had long-term capital failing in 98. You had the dot-com crisis, you had the financial crisis, you had everything that's happened over the last 10 years. So it's a long time to be able to underwrite a consumer, and you got to feel good about it. And the way you do that is looking at their assets, you look at their income, you look at how they've paid, and ultimately, are they going to continue to earn income to be able to pay your loan? So yeah, we look at everything.
When you think about real estate, I think a lot of people think about real estate prices themselves, and there's obviously volatility. In 2008, it's a great example where the prices went down. I remember I talked to Kyle Bass, who's one of the people who shorted the housing market, and I asked him, I said, how did you know to short it? And he said, we were on a call with a bunch of analysts, and they said, as real estate prices go up, 2% a year or whatever. And he goes, well, what happens if they don't? And he goes, that never happens. And he goes, wait, what? And he started paying more attention because they literally were just so kind of ignorant to the fact that prices may actually go down. And he realized the models would all break and there'd be this huge dislocation. That's pretty well understood, I think, by most people in the market now, that, hey, real estate prices go up and down, and that can cause problems. But something like Bitcoin and even stocks, as an example, in recent times, they have a lot of volatility. So stocks right now are down 20% or so. Bitcoin's down 50%. How do you think about volatility in the actual net worth or assets of the borrower?
Yeah. I think big consideration when you do a mortgage is, one, the ability for someone to pay. And I think the second component is their willingness to pay. So when you actually structure a transaction like a mortgage, you're really looking at it and making sure, does the consumer have really enough skin in the game, right? Do they actually have a down payment? What is that down payment? And is that enough for them to continue to pay in periods of volatility? It's funny that you sort of say, where real estate prices have been, because if you look at the last sort of 60 years, the only time you really had a drawdown in real estate prices, with a trend, was really through that financial crisis period. If you look at it from the last 10 years, right, it's been nothing but up and to the right. I think it's going to be interesting to see at what clip. But if you look at the last 10 years, it's appreciated at 8%, right? Last year it was 20%, different on sort of geos. But you definitely have to look at the long-term trend that, probably diversifying with real estate, it's a good thing, right? From a wealth creation perspective.
Yeah. And when you're underwriting these types of mortgages, are they all residential or they can be commercial as well?
So right now with the loans that we're doing, we started off doing mainly investment properties. So individuals that are buying properties that are cash flowing, that are generating some type of income. We felt that was a good place to start because it allows us to really underwrite the consumer, underwrite the transaction. There's cash flow, right, from an income perspective. So it fits better with our current model. Now, we want to start to originate at some point, primary homes. But we're really looking at it given, we've had thousands of people that have applied for loans with us and gotten pre-approvals. What do people want? Do they want a mortgage or do they want a property? So we're thinking creatively around that structure because a lot of the things of how the existing mortgage market and the regulation, RESPA, TILA, Dodd-Frank, all these other things, it actually doesn't work well with crypto today. So we're thinking a lot more creatively around that.
And how does geography play into this in the sense of Miami and kind of South Florida's up, maybe 25, 30%, and other geos might have only been up 5 or 10% over the last 12 months. Like, do you do geographic specific underwriting, or do you just look at the borrow itself and it's kind of a one size fits all across the country?
Yeah, we're really looking at it in 3 parts. One, it's the borrower, right? Their assets, their income, their ability to pay. 2, it's the real estate, right? The property. Do we like the property? Do we understand what this property could rent for? Do we understand what it could sell for? So that's an important consideration. And then we're also looking at just how the transaction's structured, right? From a regulatory perspective, right? Do we feel good about it? Is there an existing framework? So yeah, we really look at all components. Interestingly for us, as a company, we've done over $100 million in loans to mainly international customers buying real estate here in the U.S. And those states are generally Florida, California, Texas, Colorado, Arizona, right? Some of these other states. And we're seeing very similar trends for people that have Bitcoin and crypto wealth that they want to buy in those markets as well. So it's telling me that people want to live in desirable Sunbelt regions as opposed to some of these other suburbs.
Yeah. When you think about the investment properties themselves, why would somebody want to use their Bitcoin as collateral versus use other assets they have or job and income or something like that? Is it a necessity, or is it because there's some sort of advantage?
I think what we found with the consumers that we've done loans for, it's a desire, but ultimately it's a really strong desire that they want to keep their Bitcoin, right? Mm-hmm. They don't want to sell it. They don't want to have it trigger a taxable event for them. So for them, it's a really important consideration. And I think that the other element is just because you can sell it and have enough for a down payment, it doesn't necessarily mean you're going to qualify for a mortgage. So you need someone to understand that crypto wealth came from somewhere. You have to be able to run, KYC on the consumer. You have to be comfortable with the actual crypto itself. So it's not something that any type of lender can do. And it's one of the reasons why we came up with this product, because we felt we would understand it from that first principles perspective, as opposed to basically trying to make it fit into something else. So.
When I look on the website for the Milo Credit crypto mortgage, there are 6 things that you all kind of call out, I think is like the high level benefits, right? Yep. So the first is you can borrow up to $5 million on a 30-year loan term. Yep. You can finance up to 100%, no money required to qualify. There's low rates, 5.95% to 6.95%. Safe and trusted custodian. You don't have to sell your crypto. And then you accept Bitcoin, ETH, and stable coins. The one that jumps out to me is finance up to 100%. Explain that in terms of, I think when most people hear, they're like, whoa, hold on, what's going on here? How does that work?
Yeah, I mean, that's a big one. I think that we've given out. Let's see. So we've had over 1,000 people that have applied for pre-approval letters with us. I would say probably about 40% of those have actually gotten a letter, and a lot of those are actually they're shopping right all across the country trying to buy homes. So we have a bunch of realtors calling us up and saying, what does this mean? Because we've never heard of this. And this was really around trying to provide that solution to not sell your crypto, right? If you're basically going out and you have to sell for a down payment, then right away that sort of removes a lot of the benefits. So we wanted to allow people to just sort of pledge sort of that 1-to-1 ratio. You want to borrow $1 million, come to us, post $1 million of Bitcoin. We're still going to run appraisals, title, insurance, right? We're going to do all of these things in behind the scenes and make sure that we're really comfortable with the transaction. But you're not going to have to liquidate it. So that's a really big deal for a lot of consumers.
And so it's not an under collateralized loan. It's basically 1-to-1 where you've got to have the collateral equivalent to the loan amount that you want here. Walk me through what is the logic behind making it 1-to-1 versus over collateralized or under collateralized?
So conceptually, we could ask for less, right? So if you think about it, that if you were to basically post a down payment and you had Bitcoin, well, how much would you generally post? Well, you'd probably post 2-to-1, 3-to-1, 4-to-1, right? In terms of, from a dollars back from a crypto perspective. So we wanted to think about it in a transaction to say, all right, this consumer is not going to basically be able to get a down payment. We're going to provide that down payment for them. We're going to give them the mortgage and we're going to wrap it all into one. So that ultimately means that, yes, we could ask for half of the loan amount, but then that would introduce potential volatility to the consumer because of how volatile crypto is. Arguably, maybe not as volatile as the stock market recently, but still volatile, right? So I think that was something, really thinking about it from a consumer's perspective, where if you get a loan with me today, right, I don't want to put you in a margin call tomorrow, right? I want to give you enough room. And what we saw is that the individuals that have that 1-to-1 ratio, a lot of them actually have a lot more crypto as well. So it really strengthens the borrower profile.
So if you do 1-to-1, talk to me about, let's just, you have an example on the website that says, I want to borrow $1 million. I put $1 million of Bitcoin up as collateral. Bitcoin goes up, doubles, right? Now my $1 million of Bitcoin is worth $2 million. What happens to the loan? What changes?
Yep. So we looked at that if the value of the collateral goes up, there's an element where, depending on the agreement that you choose to have with us, you can either remove some of it or it will actually lower your rate at that point in time if you choose to actually keep that crypto with us. So it really allows you to have the benefits of essentially making a transaction less risky for us. And then the consumer is actually getting a lower rate because of that.
Opposite example, I put $1 million, I borrow $1 million, 1-to-1, Bitcoin drops 50%.
Yeah.
What happens?
Nothing in that situation. So the value of Bitcoin, you wouldn't get a margin call until it drops 65%. So that $1 million turns into $350,000. They'd have to post more, or they can reduce the loan amount. Either one is okay, and trying to get it back into a ratio that's acceptable.
If it drops 90% and I bought a house, I obviously have the house and I had my $1 million worth of Bitcoin. Now my $1 million of Bitcoin is worth $100K.
Yep.
I get margin called. I don't post any more collateral. Do you just take my $100,000 worth of Bitcoin and I keep my house?
Yeah, as long as you're continuing to make payments. Right.
Okay.
So that's that element where we created this waterfall structure where sort of the first thing that we're looking at is the crypto. Right. So if you don't make payments, then we have the ability to liquidate some of it to make sure that you're still making payments. Obviously, that's not designed to be a repayment plan, but it's really a convenience. If you stop making that payment and there's no more crypto for us to essentially liquidate, and you continue to make your mortgage payment, there's no issues, right? You can still own your house. It's still fine. If you stop making payments, then we're going to go into sort of the old way of basically having to go through a foreclosure process. The question that I get a lot is from individuals saying, well, you have the house, you've got all of this sort of home there. Why do you need so much crypto? And a lot of it is because people don't understand that having an illiquid asset like a house, it takes a long time to actually foreclose, right? On average, it can cost up to $50,000 to foreclose on a property and can take up to 12 months. So during that period of time for a lender, it's actually a liability because you have to pay taxes, you have to pay maintenance, right? You have to carry all this other elements. So this transaction with having Bitcoin and having real estate from a lender's perspective, I think it's a superior mortgage product because you have the benefits of something liquid, but then you also have the benefits of something tangible, which is the real estate.